What is going on, guys? Box here, back again with another video for the 10-minute TA series, and today we are going to be going over Fibonacci's. So to get this thing started, we're going to come over here. Now we're going to be in the third one down, and it's the first one on top, fib retracements. So you're going to click on that, and it's always anchored 2 points. So if you just click once, it's not going to do anything. You have to anchor it to 2 points. And to make it easy, we will do apply defaults. So my fibs will look exactly like yours. So now we need to change some stuff up with them. And I'm going to give you my personal preference on how I like them. So first we're going to start them out here. And then we're going to go into the settings. And then under settings, we're going to turn off the background because there's no reason to have it there. And then you can adjust any colors you want. I'm going to personally give you my fib settings, and they're right here. So it's pretty much standard, but what is added is the 6.6 and possibly the 8.86. I didn't take note when it originally did it, but these are my standard fibs, and you will understand why here in a little bit. So pause it, screenshot it, do whatever you need to do, but these are my standard fibs here. And so the way Fibonacci's work is, imagine it's just percentages. There's no increasing magic into it. It's strictly just percentages. So for example, from the top of this dump to the bottom of the dump, this is 100% of the move, right? And so if this is 100% of the move, this is, the bottom of the move, we've come up 38 or 0.38% of the overall move, right? And then we found resistance. And if it comes up here, that's 66% of the move, 50% retracement, and that is how the numbers on the side can correlate to price action. So instead of thinking of it as this magical source of wizard information, it is not. It's just a tool to discount price. So for example, when we have this pump here, we wonder why it came down here. Obviously, it came down here because you can kind of see with your eyes, there was a little floor here of buyers waiting. But another way to look at it is go bottom to the top, and you add a 66% discount. So a way to look at this is, there we go. You add a little better than a 66% discount. So when people saw this aggressive price action, they believed price was going to go higher. And so when price got to the 0.5, aka 50% level, it meant, okay, now you're not buying at value. You're buying at value, you're not buying above value. So as a tip for Fibonacci's, you never want to buy anything over the 50%. It's a bad value. You're paying inflated prices. And that is why this whole golden pocket, whatever people want to call it, all the crazy names that they give, that's why this works. The only reason it works is it's 66% off price. You have a 61 to 66% off price. So if you had your favorite car you always wanted to buy and it's only 25% off, aka right here, is that really that good of a deal? No. All right, well, now it's 38% off. Okay, get a little interest there. Well, now it's half off. Now your favorite car, your dream house, your guitar, whatever it is, your favorite thing is now half off. And what do we see? We see interest from buyers because they saw this move and then they saw another push to the upside, right? Because they saw all this volume come in, they naturally assume that the trend is flipping, and so they want to get in, but they don't want to pay a premium, but they take 50% off. So then we get our initial move. But then when it fails, and then we come down here, this is where your optimum buying entries are. The 618, 66, 786. Once we break the 886, you can pretty much guarantee the move's over. But you're looking for it to hold here. And a reason why is when you see a move retrace like this, you know that we're bullish, so you want to get in somewhere. Well, where? Well, 50% was a decent entry. You got a nice little move there, but at 60 to 70% off is ideal. You're picking up the bottom of the barrel. You should be getting the absolute lowest price if your direction was correct. And the benefit about that is if, let's say, it does fail and it doesn't go up here, and you're maybe you scale your position 3 or 4 ways. You have a order here, 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 maybe another one in there somewhere. However you want to do it, your stop loss is right below here, because you're either going to buy the absolute bottom of the discount or it's going to fail. And the best part about it is so if you buy all these, your entry is probably roughly about here. Stop loss is there, and you're going to be targeting the previous high. So as of that, that's about a 4 to 1 roughly, very, very, very roughly. But this is the idea behind Fibonacci's. It's not magic. It's not, oh, well, we find it everywhere in nature and yada, 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 and it's wizard stuff. It's not. It's strictly just percentages off a move. And if people like the percent off, then they take it, right? Because again, your stop loss is relatively close, low to the high, 66% off. That's a great deal, right? And that's another key way you can see that a move is going to continue, because if it's 66% off and people aren't buying it, well, what's going to happen? It's going to go down. It has to, right? If no one's buying an asset at 66% off, probably no one wants that asset. If it gets all the way down here, you're risking, you might get up here again. But when you get these deep stabs, it's very rare that you continue to run. Usually you'll get a bounce off the 0.5 or the 6.6. And so now that we have a rough understanding of how to look at them, kind of take away some of the mysticism around them, let's show how you actually use them. So again, we go up in here, we grab our tool. If we're looking for long side Fibonacci's, you're going to take the bottom, and you do use wicks. Don't use a candle close Fibonacci. You use the wick, and you go bottom all the way to the top, and then here's your percentages off. 236, 382, 50%, 618, 66, 786, 886, and 100%. So that's, again, how we just spoke about earlier. If it is this deep and no one is buying it, aggressively buying it, you can assume that it's going to fall, because it's just no one's interested. And again, to do long side Fibonacci's, you take the low and the high of the range, and then you choose from there. But vice versa, if you are, let's say, looking for a short, you can take the high to the low, and then what? Now you're looking at the same thing, but in reverse. So here is the whole move, just like before, from the low to the high was the whole move. Here was the whole move for the short. So the people that are looking more bearish, what do we see here? We see a reaction off the move, goes up, we get that 786, comes back down, 382, and then where? That 66% off level, because you're getting 66% off a short. So if you didn't get in all the way here on the short, and the move already happened, and you think that price is going to continue to go down, you want an optimal entry, right? And all these people thought that price was going to continue down, and so they bought at a 66% off. And what do we see? This 6.6 here was damn near the top, right? Here, and then you finally got blown through. But it works both ways, up or down, doesn't matter. You can do it either way, but just define your range and play that range. And once the Fibonacci has been broken, it's broken. You don't use it again. For example, we take this low, We take this high. And what do we see from this move? You get a 50% discount. Some people still think this is a bullish move, so they buy it. Peters out. Come into the 6-6 one more time. 66% discount. It's got to be bullish. And then it breaks. And then notice down here, once it broke, earlier in the video when I said if there's a 66% discount and people aren't buying it up, it's a very solid indication that we're going to go down. Because again, if it's 66% off, why wouldn't you buy it? It's the favorite thing. It's the asset you want. It's yada, yada, yada. If I told you gas right now is 66% off, it doesn't matter if you have a half tank, 3/4 of a tank, you are going to the gas station right this second. It's 66% off. You're flying out the door, right? And so keep that in mind. Well, if this is bullish and you have a 66% discount, why wouldn't you take it? And if not, obviously we're going to go into price discovery lower. But once we break your original fib level here, the low to the high, either or, it's broken. This fib is now 100% done. Don't say, well, box, look at it touched here, here, here. Look at all these times it touched box. It was a good level. No, it was a good level, but not as a Fibonacci level. It was a good level as in a horizontal support or resistance, right? Because we're attempting to break up into this range again. So it's not the fib that did that. Because again, fib is just advertising price. That's all trading tools are just an advertising mechanism for price. So as of now, we have, from this overall move, we have a 20% discount on the short. So if you believe price is going down, right now you have a 25% discount on it. But what most people will do, by most I mean whales, they are looking to short this here. This is where they're looking to get their shorts filled. They're going to wait for price to come all the way up here and then make their move because they don't buy at premiums. If you're looking for a short, they can only buy up here. If they're looking for longs, they can only buy under the 50% level. So, because they have massive money, right? They move markets. And so they are not going to pay a premium for price. They don't do it. Their hedge funds, whoever is managing their money, or if they're managing money, they didn't get there by buying at premium ever. That's what retail does. Retail buys at premium. For example, you have the overall of the move and we're bouncing at 38.2. So you know that this is nobody here. This is all retail. This is nobody significant because again, they can't get involved until the 0.5, 618 and possibly even lower. And again, that is why when you see it break lower, it substantially breaks lower because all of the hedge funds and banks and positions that had all their orders here now have to bail out ASAP because they see the concept like I'm explaining it to you, right? Gas is 66% off. Let's go. All right. Well, if you have your Safeway card and it's only 10 cents off a gallon, you're not rushing to the pumps. But 66% off, again, you're going. And that's how they see it. And so again, if it's not bounced around here, it's a bad idea to buy it again because it's probably going down. If it's not bouncing here, you might be able to position yourself if you believe a range is going to happen, down here at the low. But there's no point in buying anything above 50%. Do not touch it. You're late to the move. You're late. If you're looking for a long here, you're late. You can only buy down here. And then again, vice versa. With the short, again, long is bottom to top, short is top to bottom. So again, for a short, you weren't in up here. So now you have to wait, right? You have to. What are you going to do? Only get a 25% discount? Well, you got ran over. Only get a 32% discount? Well, you made a little profit, but there's no big move coming from here. We assume price action is going to come up at minimum to 0.5, maybe get a little 38.2, and then here, trap everybody, make them think it's time to go long. They get all their orders filled, a little wick up, and then we continue our move to the downside. That is how Fibs work. It is not magic. It is strictly percentages, and it is advertising the deal for you. I hope you learned something today. Enjoy.